Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have George Patterson, Chief Investment Officer with PGIM Quantitative Solutions. PGIM is the investment management arm of Prudential Financial. He joins me to discuss getting exposure to China. George, it's great to have you with us. Welcome to Trade Talks.
Thank you. I'm glad to be here.
How can investors benefit from exposure to China? What is the economic opportunity?
Well, there's several reasons why China is really a great opportunity. First of all is diversification. Like in terms of large major market exposure, it actually has some of the lowest correlation across other markets. So you really get a lot more diversification when you get exposure to China. Second of all, it's a growing part of EM, right? China has gone from a very small exposure to a very large exposure. It could get materially larger depending on how the float adjustment factor is adjusted. But really the other thing is that there's just a lot of opportunity, particularly with the China reopening trade. What you see is that when you look at China exposure that you get from Hong Kong or you get from stocks that you can get through the Hong Kong Connect exchange, that a lot of that exposure is mega cap or large company. What investors really want to get exposure to is more of the mid cap names. That's really where you see the economic exposure to kind of local China activity.
So it sounds like a single country approach for this particular investment makes the most sense.
Well, it does. It's gotten large enough that it really makes sense. If you look at the globe, I mean, people used to have a global approach, and that has broken into kind of Europe and US, and that's because the US is so big and has so many unique factors. It's the same thing in China. It's gotten so large, there are so many stocks there, that you can have a dedicated country approach and get the diversification. That's the main point. Get the diversification that you need within the country.
Harvesting alpha opportunity is only half the battle. What's the other half of the battle?
Well, the other half of the battle is risk, right? I mean, risk is the commodity that you use to try and earn alpha. And with China, there are unique characteristics in the market. Much higher retail ownership or activity in the market, tends to be a little bit shorter holding period, a little bit more trading related. But then there's also, you have to worry about state-owned enterprises, you have to worry about kind of what's happening on the ground. It is not easy to collect information. It's not easy to clean data associated with it. So there's just a number of hurdles. So we're big proponents of having an active strategy in China in order to take these into account instead of just kind of a broad index holding.
What are your thoughts with U.S. equities versus international?
So we're a little cautious on U.S. equities right now. Two reasons. One is they're just expensive. While markets may have come down in terms of a valuation level, they're still relatively expensive. Second of all, the U.S. is doing really well. The economy is really firing on all cylinders. And we are cautious that there may be potential rate hikes. I think you've even seen this in some of the curves of what people are expecting. People were expecting cuts later this year, then next year. Now we're not really expecting any cuts. So the U.S. is very healthy. Apart from some mega cap tech firms, like I don't see people cutting. I don't see companies cutting jobs. So I think it's very strong. It's been very surprising.
Well, let's talk more about the macro. It sounds like we're going to be in a higher inflation, higher interest rate environment, perhaps over the next year or two, several years.
Yeah, we've always been cautious that rates were going to come down as quickly as people were expecting them to. So we've always thought that having some commodity exposure at PGIM Quantitative Solutions, that's kind of one of the key risks that we think to hedge is inflation exposure. So having commodities, particularly when you look at commodities, commodity facilities, mining, et cetera, those take 5 to 10 years to really get something up to speed. That's been a sector that there's been underinvestment in. So we think that that's still an important part of investors' exposures. Kind of going back to the globe, there's a lot of attractive opportunities outside. Both EM could have a lot of benefits, as well as Europe, where we see actually much better economic activity than we expected. Energy prices under control, but at the same time, still relatively favorable rate and much more attractive from a valuation perspective.
It seems like there's so many moving parts. You had mentioned before that active management is really key when it comes to China. It sounds like virtually everywhere, active management, it's just much more, we're talking about it in 2022, 2023 than we did passive certainly a few years back.
Yep. Yeah, there's a lot going on in the world, and there's no question that there's a lot of risks. Obviously, we've gone through a pandemic, and we haven't gone through a pandemic in 100 years. There's there's always risk, and you don't really always know like what's just below the waterline. Like, what are you going to run into when something changes? And so yeah, you always have to be cautious of those, and you just need to be able to pivot quickly.
Right. All right, George, we appreciate the insight. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.